Welcome to the broadcast. My name is Marty Schenkman, and I'm joined by three colleagues, Jonathan Blotmacher, Lou Harrison, and Thomas Tietz. And we're going to talk about a recent case that many have dismissed as just another one of the many bad fact cases, but it really has, I think, some critical reminders to all of us about appropriate steps to take in estate planning. Now, before we get started, let me just go over a couple of quick admin points. Forgive me, but let's just do that. So the PowerPoint is available. You can download it from the web console. If you click on handouts, it'll be right there. You can download it to your desktop, laptop, whatever you're at, print it, save it, do anything you want with it. It's in PDF format. If for any reason you have trouble doing that, there's always a few that do. It's posted to schenkmanlaw.com on the front page on the blog post. If it's not, Tom, you'll make sure that happens. And within a few days of this program airing, what we're going to do is post a recording of the program and the materials to schenkmanlaw.com so you can access it there. We do not give CLE or CPE credits. We will send you through the system a certificate of attendance. We cannot control the certificate of attendance. If an admin person in your firm signed you up, and the certificate will probably go to their email, and all that was disclosed in the advertising. If you have questions, the best thing to do is not to post them in the question or chat box, but rather email the individual panelists. The last slide in the PowerPoint has everyone's email, and I'm sure everyone on this program will be more than happy to help you with that. So, Jonathan, do you want to make a quick comment about our sponsors, Interactive Legal and Peak Trust? And if you want, I can plug Peak Trust and you can plug Interactive.
Well, fine, Marty. Maybe you should plug them both. But in any event, Interactive Legal, which is a company that I've been involved with for over 25 years, provides standard estate planning documents like wills and trust, power of attorney, buy-sell agreements, and the like. In fact, it also has some unique forms, which I think are just the cat's meow, like the extra crummy trust, for example. We also appreciate at Interactive that we're not selling you a product, we're selling you a service. And the staff is extremely helpful when you raise questions about the operation of the system or how it fits into someone's estate planning. I hope you'll take a look at it. We have thousands of users, including many, well over hundreds of ACTEC members who use Interactive Legal products. And you can go to sales@interactive.com, and you can call the number and speak to Vanessa Canega, whom I had the privilege of working with at Milbank for many, many years, who now is the president of the company. Marty, over to you.
I'm actually a user of Interactive, and I can tell you that it has transformed how I do the practice of estate planning. It has changed the profitability of planning. It has changed the entire dynamic of planning. It has made planning, drafting, it's changed everything about it. Less time, more time doing planning than drafting. It's really an incredible tool. So I encourage you all to give thought to it. Peak Trust Company is our other sponsor. I have had my DAPT with Peak Trust since 1998. Within 6 months of Alaska passing the country's first DAPT statute, I said, this looks cool. And that was before I even knew who Jonathan was. And they provide incredible service. We are finding that even in these waning hours of 2021, they still manage to turn trusts around within 2 days, which is remarkable. So contact information for Nicole King of Peak is there, and thank you to Peak for being one of our other sponsors. So let's get started with the case. So Smaldino, and the site is on the top of slide 8. There are two broad aspects to Smaldino, and in this hour, we're only going to talk about one. And we're going to dig in depth, which is something that many of the webinars that we all hear, cover a million miles with an overview. Try to spend some time on this, because I think the lessons are that important and it takes time to talk about them. So one aspect of Smaldino, which was quite interesting, are valuation issues. We're not going to address those at all. I suggest to all of you it's worth taking a look at the case to familiarize yourself with some of the valuation questions that came up. Quite interesting. What we're going to talk about, which was, I think, at the heart of the main issue in Smaldino, was why the planning failed. And again, as I said in my very quick introduction, we could dismiss Smaldino, another bad fact case, right? We don't have to think about Powell because it was a bad fact case, but most people seem to think a lot about Powell and try to differentiate their situations from Powell. And I think Smaldino is the same kind of case. And one of the things that I think is very important, and we'll talk about it, Smaldino, it seems in the case, if there were 6 items they could have done wrong, they did all 6 wrong. But that doesn't help us by saying or teaching us or giving us authority to say, golly, if I only do 5 things wrong, the matter will succeed. I think the better application, and that's what we're going to do in this discussion of Smaldino, is to identify each issue that was done wrong and for all of us to try to get all of our client matters to do 100% right. Because no matter how hard you try, no one will do everything right. From a planning perspective, it was a simple case. Husband gave interest in an LLC to wife. Wife then gave interest in those LLC membership interests to a trust, and that was the plan.
The trust, Marty, of course, was from the father's children, not for the wife to whom he had transferred the interest initially, or for anyone in her family.
That's
and Marty, how much time lapsed between the time that the husband gave it to the wife and the wife then transferred it to a trust for the children, his children?
You're cutting to the chase, because that's at the heart of the key problem in Smaldino. But there's a lot of nuances we're going to talk about. She only had it in her name for a mere day. She only had it in her name for a mere day. And we're going to talk about that and contrast that to the Holman case, which was quite different. And we're going to try to discuss how long is long enough. And there's no real answer for that. Now, on slide 9, Mr. Smaldino was a CPA. He even worked as a CPA before going into real estate. And Mrs. Smaldino had a master's degree in economics. My impression, and I don't know if any of our panelists felt differently, was the court kind of felt, listen, you folks have the background. You should know how to do this stuff right. Mr. Smaldino, as a CPA, certainly should have understood the legal and tax formalities that should have been observed. Mrs. Smaldino, with a degree in economics, should have really understood, and we'll go through the facts as we go through the PowerPoint, that she had no real economic implications to even the one day she owned it. It wasn't only, as Jonathan correctly pointed out, that she held it for one day, but there was no consequence to the one day. She certainly understood that. With the wealth level you'll see that they had, the real estate portfolio, and this was only part of the plan, was $80 million. So what was the overall estate? We don't know. 150 million, 200 million, 125 million. The level of wealth they had, they certainly could have and should have hired a collaborative team of advisors to do this right. So the first lesson, and then I'll ask the panelists to talk about it. One of the things that we have to do as practitioners is gauge the client's willingness and ability to do things right. We all have had clients, we all probably have clients in our office right now that don't want to give the attention to the planning that they should. And lots of clients, once the documents are signed, they're gone. I paid my lawyer, I'm done, I don't want to deal with this again. Lou and Jonathan, maybe Lou first and Jonathan, do you want to comment about that point with clients and what we need to assess and how we can educate clients to do better?
And this is why I think the Smaldino case is so important, because it's teaching us that contrary to what the clients say about administrative compliance, it is essential to respect the integrity of a transaction. The Smaldino case, as we're going to talk about, has all sorts of problems in the structure, but the reality is the court didn't believe that the transaction was a real transaction. As Marty's going to talk about, they used sham transaction principles, and the client absolutely didn't want to comply with the formalities. And if a client's not going to comply with the formalities, we got to do one of two things. The hard thing, which we're not really capable of mostly, is to say goodbye to the client, because you're asking for trouble, as the Smaldino case indicates. The second is, independent of the client wanting to do the formalities, we have to do it. We have to do the formalities. It's shower hammer revisited. I don't know how many times we have to learn this lesson, but we can't tolerate clients who refuse to do administrative details and dot the I's and cross the T's.
Jonathan?
Let me add,
Jonathan?
I've always felt that the taxpayer gets the lesser of form or substance. Even if your form is perfect, and I think that the Smaldinos argue that their form was perfect. Mr. Smaldino gave it to his wife. He in turn gave it to the trust for the children. That was the form. But the taxpayer doesn't have to just do perfect form. He or she also has to do perfect substance as well. Keep in mind, the taxpayer is going to get the lesser form or substance. Also keep in mind that, you know, basically we have a number of what I call mystical tax doctrines. I mean, they all go back to substance over form, but it's step transaction, which you could say was the heart of the Smaldino case. It's lack of economic effect, or a variety of other things that the courts use, just not take the taxpayer's word that they should get the tax effect of what they're doing. This all started with Gregory versus Helvering, in which Mrs. Gregory acquired a corporation by her corporation, merged it immediately, and then terminated it. And that fit perfectly into doing a combination of corporations and being able to have the acquirer get the tax benefits, especially the losses that the acquiree had. But the court said, because this happened, you know, basically in one day, similar to Smaldino, the court said that's not what Congress had in mind when it put in this provision for a tax-free acquisition and liquidation. Again, that goes back to what was the substance of the transaction. And the substance here, I think, Marty, and I hope I'm not giving anything away, the court felt that all of the transactions really would be deemed for substance purchases as won by Mr. Smaldino. His wife's position in this was, you could say she was merely a straw person, for example, but it doesn't matter.
We're going to go through all that detail, go through the slides. So let me take a slight sidetrack, and I know this is something Jonathan is going to speak passionately to for a moment or two, and Lou, you should chime in. There was a recent case, and Jonathan, let me just tee this up for you, and you can get as emotional and as impassioned as you would like when you answer. But folks, this is critical. This is not just about the Smaldino case and what happened. What's going to happen, and we haven't heard about it yet, but what I fear may happen in Smaldino is just what happened in a significant case called Rhea in New Jersey, and a recent case that just came out, and it's still in process. I think it's in Massachusetts. Jonathan, you can correct me if I'm wrong, called Wellen. What the clients did in both of those cases, both malpractice cases, is when things went south, each of these clients claimed the lawyer never told me. And I could see in the Smaldino case, potentially, assuming that Mr. Smaldino didn't handle all the paperwork on his own, and I suspect he had a lawyer, but we don't really know too many details. Gee, the attorney never told me one day wasn't enough. The attorney never told me that we should do all the things that we're going to talk about. One of the significant risks that we all face as practitioners when planning isn't done right, or as Lou discussed, how clients don't often follow up. When clients don't follow up, don't deal with administrative matters, they point the finger at you or me. That's what we have to be mindful. Jonathan, you want to comment for a minute or two? I don't want to get too sidetracked, but I think it's really a critical point about Wellen and what that means to practitioners in light of the Smaldino case and what might happen here.
Sure. Wellen is a case. It's a Fourth Circuit case. It's not been officially reported, but you can get it. And basically, in that case, the attorney recommended basically a note sale type transaction or an installment sale to a grantor trust. And it was put into a grantor trust. And as everyone on the phone knows, when you have assets in a grantor trust and the trust experiences income or gain, that's going to be attributed directly under Section 671 of the Internal Revenue Code to the grantor, so that the grantor has to pay any consequent income taxes. Now, all of us know that that is a very good thing from an estate planning perspective, because it allows the recipient, the trust, to actually have growth and income billed entirely free of taxes. In other words, the trust experiences tax-free compounding, which is probably the most significant force in all of financial planning to build wealth. Diana Zadel and Robert Weiss and I did a study many, many years ago. It was presented at Heckerling in 2007, in which we compared installment sales to grantor trust, which is what really happened in the Wellen case, to a GRAT or a series of GRATs, like rolling GRATs, and to just a straight gift to a grantor trust. It was that the installment sale to the grantor trust was the winner of all those strategies, and we went back in and tried to figure out why was it so successful. The reason was the ability of the trust to acquire income and gain entirely free of income tax. That is the key element. Now, that means the grantor pays the tax. It's like making tax-free gifts. And in fact, there are proposals in Congress, which are not contained in the House bill that was passed last week, but actually the week before. But they are not, in fact, it's one of the most powerful things in all of estate planning. But in the Wellen case, the assets that were put into the trust were sold. And the client said, well, that was bad. I wasn't informed. It shouldn't have happened. It's all benefiting my children. The attorney was in a position of conflict of interest. And we'll have a special program on that. But the bottom line was, you've got to inform your clients, even though everybody of significant wealth should know, for example, that there's a tax-free step-up in basis at death. There's a case in New Jersey where the client said, no, even though we were in billions of dollars, we never knew about the tax-free step-up in basis at death. And we didn't realize that when we got assets out of our estate, that we wouldn't get the step-up basis. Now, you can take a look at an article that Mitchell Gans and Hugh Jacobson and I wrote in the September 2002 issue of the Journal of Taxation, which talks about why we think you still do get a tax-free step-up in basis when grantor trust status terminates by reason of the death of the grantor, even if it's not includable in her estate. And in fact, Bernie Sanders has a proposal in Congress which would overrule that position, which gives me comfort that Mitchell and Hugh and I were indeed correct. But the bottom line is, clients are going to say, we never knew about this. We didn't understand the law. We don't understand anything. You didn't tell me enough. Yes, you sent me a letter about it, but I don't read letters from lawyers. I actually had someone try to pull that on me one time. You've got to protect yourself. You've got to make sure they understand. And in fact, perhaps, and Marty has done this with some of his engagement letters, you say, we are not telling you everything. There will be consequences that could come up, which we haven't told you about. If you have any issues or want anything other than the narrow stuff we're telling you about, it's up to you to ask. Don't come back and say, well, you didn't tell us about the rule of Shelley's case. You've got to protect yourself every single time. Marty, why don't you tell them what you put in your engagement letters now?
I'm feeling kind of timid right now because I can't remember the rule of Shelley's case, and I should know it. Oh no.
Well, there you go, Marty. You're guilty of malpractice.
I'll call you after the webinar. You'll tell me about Shelley's case. We have not only in our retainer agreement, which we call a representation agreement. We just did that so it didn't sound like it was only about money. But we have a paragraph that provides that there are no guarantees. We have in the footers on every bill that goes out of our office that there are no guarantees. There's risks with everything. Even when planning is done in as close to a pristine manner, gee golly, we can't predict changes in the law or court cases or how things may play out. We also try to, for more significant transactions, we have and this came out of the Rhea case. I started doing it right after the Rhea case several years ago. I have what I call a risk factors checklist, where we start with a template and then we tailor it, modify it for each transaction. It's about, how long is it now, Tom? How long is the document?
I'm pretty sure we're up to about 12 pages at this point.
Of risk factors that could affect any transaction. And there are a myriad of risk factors. You can't predict inflation. Look at what happens if inflation kicks up to GRATs and other planning techniques. Things could either work out better or completely go south just based on inflation or changes in interest rates, all of which may happen. So planning that we're putting in place right now, you know, if you do a short-term note sale a few years ago because interest rates were low, and in 5 years that note matures, you may have to renew it or renegotiate it at a rate that's a huge multiple of the prior interest rates, and it may not work. It may sink the ship of the planning. We can't control any of that. Lou, do you want to comment at all before we go on?
Yeah, Marty, in addition to what we're advising clients, and Jonathan said it well, we can't advise them on everything. I think it's incredibly important on the compliance side, where we cannot, as service providers, we can't tolerate sloppy compliance. We can't tolerate sloppy follow-up. We have to be careful of shortcuts, and most importantly, as you'll talk about in Smaldino, we have to react carefully to when clients create emergencies on tax planning, or when we think emergencies are created because of proposed bills. We have to act in a prudent, careful, slow it down kind of way, so that we're not taking shortcuts to get to answers that are going to be difficult to defend if they're challenged.
Slide 10.
I just want to say one
Tom?
quick thing to
Marty,
extend.
let me mention one other thing.
Go ahead, Jonathan. Sorry.
I was going to say, you will all remember, if not vividly, that everybody on his or her letters and stuff had this circular 230 disclaimer. And maybe that's what you need to put in your engagement letter, where basically you're saying, I'm only telling you about this. There may be other consequences, and unless you ask us about those, we're not going to tell you. One of the problems of doing a 12-page or 100-page disclaimer is that the client's going to come in and say, how could I possibly understand this? It's all legal gobbledygook. This person was supposed to be representing my best interests, and they put in this thing that I can't possibly understand. How can I hope to understand it? Should I hire another lawyer? Did my lawyer tell me to hire another lawyer to go through this and maybe negotiate? Again, I think you want to keep it relatively simple. To go back to what you put on your circular 230 disclaimer, we are only discussing this. There may be lots of other consequences, and they are not being covered, and they're not going to be discussed, and we're not responsible for those unless you separately engage us about those. So if you're doing an estate plan, you can put in, we're not talking about excise tax. We're not talking about income tax. If you engage us on how those taxes or anything else might be affected. Let me give you another example. You have a client who's married, and the client tries to do some estate planning, but all of a sudden you've triggered rights of the other spouse with respect to that property, and you didn't tell the client about that. Are you now guilty of malpractice because you didn't tell him or her about those other consequences? That's why you have to narrow what you're doing, narrow what you're representing you're going to do, and say, if you want to find out about anything else, separately engage us. At least that's my feeling about it, Marty.
You were going to comment?
I was going to expand a little bit on Lou's point about following up on the formality. When you have a sophisticated client like the Smaldinos, they had an $80 million real estate empire. I wouldn't be surprised if they had their own administrative team that they had to handle the aspects in this case. Practitioners need to be careful if they have a sophisticated client that has that kind of team, that they review the administration that was put in place, the documentation that was there. Because in the end, the practitioner is the one that's going to be liable for any situation. If the client is doing it wrong, if the practitioner themselves have the ability to mention that fact, it will help and make a difference here. It protects the actual client himself. And it also protects the practitioner in that situation.
So I'm not going to go through it now because we'll save it for a webinar that Jonathan is now committed to do with me on the Welling case. But I have a different perspective on what Jonathan said, but we're going to stick to Smaldino, and I will arm wrestle Jonathan when we do the next webinar, and we'll make that webinar at least 90 minutes in length, so I have time to arm wrestle him in full public view. So what happened, and Lou, you kind of already commented, but I'll give you a second at the end to comment. This is so common with clients. This planning was started in 2003, but it remained inactive until late 2012. And golly, I think everybody on the call knows what 2012 was, where we thought the exemption could drop from 5 million to 1 million. So all of a sudden, Mr. Smaldino had a health scare and obviously started jumping, let's plan, let's plan, let's plan. We all have lots of clients like this. It's usually a problem. When you have a health scare or any artificial emergency, like what we're dealing with for the last year, almost 2 years now, since, maybe May of last year, 2020, of, oh my gosh, they could change the law tomorrow in Congress. And we're still, oh my gosh, they could change the law tomorrow. And so far, nothing's happened. We'll see. Maybe it'll change tomorrow. Lou, talk just very quickly about any comments about emergency rush planning. And I know you made a few comments already, but maybe you want to add to that.
So I'm going to talk about drafting because I think we've all been here where the clients come in, they're ready to sign the documents. They've read or have not read the documents, but in their minds, a change is required on the documents, and they don't want to come back. So they'd like you to make that change while they're sitting there, and you make the change, and you're pretty certain it's right. And a week later, 50% of the time, you don't like that drafting, and they're back re-signing documents. That's just on signing estate planning documents. When you're rushing estate tax planning, as sophisticated as estate tax planning is, you are bound to forget one or two items. It is not a good situation for us as practitioners. You got one or two options on that. Either you do it because we like to please our clients, and then you better check it post-transaction. Or a more prudent approach is slow it down. Even though the client's going to be upset, you got to tell them we're not going to do this on an emergency basis.
Absolutely. Now, let's talk about the facts. Tom, do you want to describe the LLC that was set up?
Absolutely. So the LLC that was set up in this situation was set up in California, and it was initially owned by a revocable trust that Mr. Smaldino also set up in California. Now, an interesting point was this LLC was initially set up in 2003, but nothing happened with this LLC until 2012. So we're going to discuss this later, but it's almost like Mr. Smaldino began his estate plan in 2003, but tabled it and put it to the side for almost 10 years until there was a situation like we talked about previously. He had a health emergency, as you saw on that slide. They created this LLC, and in 2012, they added 10 parcels of real estate to the LLC. So the LLC owns the real estate, and then the LLC was owned by the revocable trust. So Mr. Smaldino himself initially added 8% of the LLC to a Dynasty Trust, of the Class B non-voting unit to a Dynasty Trust, because they had 10 Class A voting shares and 990 Class B non-voting shares. So the goal there was to retain control separate from what was transferred to the Dynasty Trust, which is a pretty common technique that estate planners will use. So Mr. Smaldino himself transferred 8% of the LLC to this Dynasty Trust. And then he transferred 41% of the LLC interest to his wife, Mrs. Smaldino. And she subsequently, the next day, and if I remember correctly, it was April 14th, 2013, Mr. Smaldino transferred the LLC interest to his wife. And then the next day, April 15th, 2013, she transferred those LLC interests to the Dynasty Trust.
Just a quick comment.
Marty and Lou, let me ask you a question. If she had transferred it to a trust of which she was the grantor, in other words, she hired a lawyer, she got the units from her husband. If she had hired her own lawyer to do a trust for his descendants rather than add it to the trust he had created, would that have produced a different result? And even if it wouldn't that be a better step than just adding it to what he had already done?
Lou?
I don't know if it's a better step on this one, Jonathan, but Marty's going to expand on the timing with regard to the transfer of ownership and the lack of formalities with regard to Mrs. Smaldino actually treating it as her property. I think that's more of a pivotal item than where the property went after the fact.
If nothing else changed, I don't think it would have changed. Why didn't they just gift split anyone? Wouldn't that have solved the problem? No need to give it to Mrs. Smaldino for her to give it the next day to the trust. Why didn't they just gift split? Would that have worked? She wasn't a beneficiary of the trust, which doesn't work in slats, which is a common issue, or it doesn't work in this. It's a HEM standard. That's another whole discussion. But what about gift splitting? Wasn't even mentioned that I saw in the case.
Well,
no, it's not, Marty, and I think that was perhaps a mistake by the lawyers. If they had anticipated that, gee, maybe the step transaction or substance over form doctrine would apply here so that she would not be considered the donor, what they should have done is consider what other alternatives are there. Now, I don't think the case states whether or not Mrs. Smaldino was a U.S. citizen or not. Presumably she was, because they would use her big exemption, or maybe she was a resident. But you can give split with your spouse even if he or she is not a U.S. citizen.
The other thing, just as an aside, folks, and we're not and there's a number of ancillary comments in the PowerPoint, but we're not going to dwell on them. You know, I don't know why Mr. Smaldino didn't use a floating spouse clause. Maybe the estate was so large that he had more than adequate resources for her, but I just like building in flexibility. I don't know why they'd put 8 or 10 real estate properties in a single LLC when you have an $80 million portfolio. I would have every single property in a separate LLC. There are just a whole lot of questions about the planning here, but let's go on. And the lesson of what happened with the LLC is planning conceived or completed under pressure should be followed up upon later to see if any portion of the planning was either missed or not implemented correctly. So doesn't that apply to everything all of us have been doing in 2020 and 2021? I'm going to send out a letter next year. Presumably by then we'll have an idea what Congress is doing, maybe not. But once we know, I'm going to make sure I get a communication out to every client that's done planning. You have to come back and review everything that was done in 2020 and 2021. Because there's just no question that even if we did what Lou said and tried to slow it down, there was tremendous pressure last year and it replicated this year. There's going to be things that are missed in every plan. Clients have to come back. They have to review the entirety of the plan. And at some point, maybe next year, we'll do a program on how we organize and why you need to really carefully organize all the documentation on a plan. We use an approach of creating a comprehensive checklist for most plans so that there's a record of what documents need to be done. There's a record of what was missed. And that's sort of the framework that we use to identify that. I'm going to skip the ancillary comments. We addressed a few. Tom, do you want to just briefly explain the Dynasty Trust? We've kind of covered it, so you can do it quickly.
So the Dynasty Trust was also established in 2012 and was funded in 2013. So like we just mentioned, this was done at a very busy time for practitioners. It was also done at a time when there was a health scare for Mr. Smaldino. So they did this very quickly. 8% of the LLC Class B interests were transferred by Mr. Smaldino himself. 41% were transferred by Mrs. Smaldino into the trust. So I believe this is mentioned at a later point, and this is about the transfer itself. But the Dynasty Trust received these interests through an assignment that was signed effective as of April 15th by Mrs. Smaldino.
We're going to go through the assignment, Tom. We'll do that, we have slides just on that.
Okay. So that's really covering everything on Dynasty Trust as we talked about when we talked about the LLC.
Okay. So the heart of the case is on slide 17. Mrs. Smaldino got a gift, and the next day she regifted it to the Dynasty Trust. She only held the interest for a day. Now, another one of the issues in the Smaldino case, and we all see this probably last year and this year to a greater extent than normally, where spouses are retitling assets as between them to use an exemption before that exemption is supposedly going to be reduced by Congress, right? Now, that wasn't in the last House bill. We don't know that the Senate may not reintroduce it, but for most of 2020 and most of 2021 as well, we were all concerned for clients using exemption before it decreased. So we're all going to see these issues. But one of the things that she did that the court also commented on, and it made the transaction look circular, is whatever interest she got were the exact interest she transferred on to the Dynasty Trust. Circularity is never a good thing in a plan. Lou, do you want to make any comment on that?
So on the transfer to spouses, it's so easy to transfer an X% interest to one spouse and have that spouse transfer something less than X%, either to a perpetual trust or even to a SLAT. We're going to talk about timing in a second, but you don't have to transfer the same interest back and forth. And that's the same with a Grantor Trust when you do a sale. When that Grantor Trust is getting payments from the asset that it purchased, it doesn't have to turn around and use those payments to pay down the note. It can create a timing difference, and it can create a difference in amounts. And that would have made a difference in the Smaldino case as well, Marty, as the timing, which I know we're going to emphasize.
In Smaldino, the list that we've been going through just keeps growing of things that weren't really done well. A number of the things that we talked about, from gift splitting to separate LLCs, weren't even brought up in the case, but it just looks like the planning didn't get the TLC in the time that it deserved. And I'm not criticizing the practitioners. Mr. Smaldino was a sophisticated, wealthy client. He may have dictated what he wanted done, and it sounds like the timing was also dictated by the Smaldinos. But lots of issues. So the lesson now, how long? And Jonathan, I want to ask you to comment about Holman in a minute, but how long is enough? So we think 1 day wasn't enough. Mrs. Smaldino held LLC interests from 1 day and then retransferred them. And we're going to come to the dating and the effective dates because that's yet another defect or issue in the case. In the Holman case, which you may remember, there was Dell stock put into a partnership, and the Dell stock was only in there 6 days before the gift, yet the court somehow accepted 6 days as sufficient time, and they pointed to the economics that publicly traded stock, you could have a significant change in value in 6 days. And because of the volatility of the underlying asset in the partnership, the court agreed in Holman that 6 days was enough. Now, Jonathan, I don't think anyone is going to advise a client that 6 days is enough, even if you have the Holman case to point to. But what is really enough time? What do we need to know about time that someone needs to hold something or an entity needs to hold assets before we can do another leg of a transaction? How much time do you need?
Well, Marty, as you know, there is no bright line rule as to how long it has to be. In fact, the IRS, in its brief to the court in the Holman case, said if they had waited 30 days, we wouldn't have raised this issue. And I'm not even sure the IRS was wise to have put in a footnote in its brief to the court. But it said if they had waited 30 days, we wouldn't raise it. Now, let me tell you about a case which you can really worry yourself about. It's called D. Goldschmidt Rothschild versus Commissioner. D. Goldschmidt versus Rothschild versus Commissioner. It's 168 F. 2nd, 975, 2nd Circuit, 1948. Where a woman was caught in the United States during the war, and she wanted to make gifts of certain stocks she owned to trust for her children, but even though she was not a resident or a citizen, would have been subject to gift tax. So she was advised by Brown Brothers Harriman to sell the stocks, which they did. Then they made gifts of assets which were exempt under the law. And then later, the trustee of that trust sold those assets and repurchased what she owned when she came to the United States. And that was a space of years. And yet the Second Circuit said, no, we're going to apply the substance over form step transaction, even though she was not in control. That she was aware of it, she could have asked, but she didn't have even the power. You had an independent trust company doing these things. So the bottom line is you can never be absolutely positive. Probably the safest thing to do is to show that the recipient of the gift, in this case it would have been Mrs. Smaldino, had had some real control and benefit from the gift her husband made to her. She should have voted the interest at one time. She should have received a distribution of it. Perhaps she should have sold part of it. In fact, one of the things that Mr. Smaldino probably should have done is to give her not just interest in those LLCs, but other assets as well, some of which she could have sold, some of which she could have kept. But they just had to do this all within 24 hours. That's almost a recipe for disaster. How much is safe? It depends. But try to show that the donee of this property, before she retransfers it, can go ahead and take action and show it's really hers. She benefits from it and she can control it. Like maybe she should have given some to her relatives.
I think that the point Jonathan made is critical, and it's something that we should all try to do, circumstances permitting. Distributions while the spouse holds it is something that certainly shows the economic reality. She got an economic benefit if she got a distribution. So if you can have the entity make a distribution during the time period the new owner holds it, that's helpful. Where it's been feasible, we had significant contract documents signed and approved by owners, members of a transaction. Signing an operating agreement or other appropriate governing document to me is critical, because you want to show that you're respecting that ownership, and that's going to all come up in what we have. I remember hearing John Porter speak, and forgive me, John, if I'm not paraphrasing correct, but he made a comment, perhaps based on Jonathan's comment from Holman, that 30 days is probably the minimum, but I don't want to say any hard and fast rule, because Holman did accept 6 days. And if you get independent economic consequences, like legal consequences, like Jonathan talked about, that could shorten the period and certainly support it. But he said something to the effect of 30 days is the minimum, 60 days is better, and longer is better still. But the reality is, and this is something we all face in 2020 and 2021, we don't know when Congress may act, right? We're now thinking at this juncture that we may have a tax bill before Christmas. We are thinking that it's possible that the Senate reintroduces all the Grantor Trust restrictions that clients feared and that the House did not include. We don't know. But since probably May of last year, 2020, we've all been operating, let's get this done now, because we don't know when the law may change. We even operated for much of 2020 and 2021, and I guess it's still possible that they could make retroactive changes. And with the fear of the specter of retroactive change, you know, the faster you get something done, the better. So this is going to be an issue we're all going to see on lots of deals that we've done in terms of timing. And we'll have to see what we can do. Now, if you're still doing a deal, follow the advice that Jonathan and I just gave, and have independent legal documents signed, make a distribution, do what you can, even if it's a short time period, show what it was. Tom, do you want to just explain what happened with intent on slide 21?
Absolutely, and it actually ties into another point I was going to make about economic benefit to the spouse. So in this situation, Mrs. Smaldino, this was a blended family. So the children that were the beneficiaries of this Dynasty Trust were Mr. Smaldino's children, not Mrs. Smaldino's children. So with the way that they structured this transaction, Mrs. Smaldino was making a gift to a trust for children that are not hers and using her estate tax and gift tax exemption and making that gift. Meanwhile, she didn't receive anything back in that situation. If you take a look at the first paragraph, it says that she testified during the case that she had made a commitment, a promise to Mr. Smaldino and his family to gift these assets immediately back to this Dynasty Trust after she received it, and that she believed in fairness, and that because she made that promise, she had to give these assets to children that are not even hers. So she received nothing for using her estate tax exemption here. It makes it look like this was a preconceived notion. She never was going to do anything with these assets when she received them. How could she have dominion over assets that she was intending from the very start, before she even received them, to gift out of her control and for no benefit to herself the very next day?
Hey Lou, could you imagine a client giving worse testimony?
This is pretty bad, actually.
Any suggestions,
We should
thoughts?
Marty, never underestimate what a client's going to say on the stand.
You kind of wonder. I mean, did Mrs. Smaldino, she has a degree in economics. Didn't she understand conceptually that if she's just handing stock with no intent of holding it at all to a trust that doesn't even benefit her, that it would undermine the whole transaction? I would think her testimony alone, if nothing, everything else was even done right, would have been a significant issue, because her testimony basically undermined that there was any intent for her to have any economic benefit from it. So yeah, we all have to make sure clients have some understanding of what the transaction is. And we'll talk about this when we do a webinar probably early next year on the Welling case. And I promised you all I was going to disagree with Jonathan in that webinar, and we'll duke it out. But I think when you have clients that are worth enough money to be in the wealthiest 1%, and this client may very well be in the wealthiest 1/10 of 1%, they have to have some degree of sophistication that the average bear doesn't have. They should understand this stuff, and they certainly should have the ability to. But we'll talk about that. Now, formalities is another whole topical area, and we're going to go through it. They just didn't respect anything in the Smaldino plan. They seem to have ignored everything. We all know the classic example of setting up an entity, LLC or corporation, to limit liabilities from creditors. And if you don't adhere to the formalities, you pierce the corporate veil, you pierce the LLC veil. There's law on that as well. But nonetheless, even though Mr. Smaldino was a CPA and obviously a very successful real estate owner, developer, they ignored all the formalities. It's not only a question of the implications to the tax planning, but it's a question of implications to asset protection planning. He put 8 or 10, I forgot what the number was, properties, it seems, in a single LLC, that could have had a domino effect, that if there was a suit on one property, he could have lost the whole empire. So there just wasn't any respect to property formalities. There wasn't respect to the operating agreement restrictions. Just quickly, the operating agreement that obviously Mr. Smaldino was responsible for, I assume he had counsel prepare it, but we don't know. He may have, gotten a form from an old client or something and used that. We don't know. But the operating agreement had restrictions where there had to be certain approvals before the transfers were made. And they ignored that. So if the client's going to ignore the very formalities in the document that they're responsible for and they signed, how is the court or creditor going to respect that? This is something that we all see. And again, I'm worried for all of us with the pressures of 2020 and 2021. Did clients, if there's a lease that requires tenant approval, did they get the tenant approval before they made transfers to a trust? If there's a lender, did the client get lender approval, or they said, the heck with it, I want to get this exemption used before the law may change, and they just made the transfers? Those are the kind of things we must get clients to circle back and address, because those formalities obviously have legal consequences, right? The lender could call the loan, and if interest rates are going up, they will call the loan if you violated it. And the IRS may raise it as the client ignoring everything. Tom, do you want to comment about the LLC? Any further?
So, yeah, I just want to make a couple of quick comments. So, when you're establishing an LLC, you need to reflect the governing documents for each phase of the transaction as you're doing it. So, as you see in the first bullet point on the slide on your screen right here, the day after they transferred the interest to Mrs. Smaldino, they signed an operating agreement showing the family revocable trust that Mr. Smaldino established as still the sole member. So not only are they not signing operating agreements that reflect the ownership, they're actually signing operating agreements here that disrepute the phase of the transaction that they were in. So Mrs. Smaldino at the time owned the interest, but they signed an operating agreement that disagreed with that fact. So they're presenting here a story that has contradictions in it. Establishing governing documents that follow the phases of your transaction, that support the arguments that you're making, helps you and it helps the client. It helps you, the practitioner, show to the court that you're respecting that this is a separate legal entity and what you're doing with that particular legal entity. So being very careful here, unlike what the Smaldinos did in their situation, helps support your transaction.
How much work, folks, does it take to take the operating agreement you have in Microsoft Word on your computer and change the dates, change the membership interest, change it from, first or second amended and restated to third amended and restated, and re-sign it? And then when Mrs. Smaldino retransfers to the trust, do the fourth amended and restated, date it properly, and we're talking about dating in a minute, and re-sign it showing the trust. I like to see governing documentation every step of the way. And one of the feelings that I have is, from a step transaction purpose, from a reality purpose, from a creditor protection purpose, I want to be able to say that if we stopped the planning at any point in time, we had all the legal documents in place that a third party would have. No third party would buy into an LLC that owns rental properties and not have an operating agreement confirming their ownership. We should do the same for every phase of an estate plan. So the lessons of the saga are simple but central to defending the structure of the plan. All formalities should be adhered to. We should insist on clients having the right formalities. We need to communicate with clients about what formalities their trusts and entities and similar planning structures, because there's contractual arrangements and so on in a lot of the plans we do, should have. And that's something that, again, I think next year we should all be sending a letter out to our clients, explaining how and why every phase of every plan done in 2020 and 2021 should be dealt with. Now, I'm not saying that in 2022, if we go back and create an operating agreement for a 2020 or 2021 transaction that may have been missed, that's ideal. It's certainly not ideal. It would have been better to have been done in real time. But if you have an operating agreement that was dated in 2022, said to be effective in 2021, and it fills in those gaps, at least you're showing that you're trying to respect the planning. I feel that's far better than waiting to have an audit and the IRS say, hey, you didn't do it. I don't know, Jonathan or Lou, do you have any different thoughts or disagreements with what I said about even later cleanup being better than nothing?
Marty, I totally agree with you. And the reality is we should be looking at all transactions we can do to improve what was in place. And it is better to have something in place before the IRS questions you, because once they question you, no further documents can be created. You are done at that point. So I 100% in agreement. It's a worthwhile endeavor to see what improvements can be made to a transaction after the fact.
Yeah, Marty, as I said, the taxpayer is going to get the lesser of form and substance. Here, their form was terrible. They never made her a real owner. And so they failed on form, which means the taxpayer is going to lose the case. Now, sometimes somebody forgets something. It's a ministerial, mistake that they forgot to do something. And Marty, as you said, you could possibly clean that up later, saying, oh, gee, yes, she was a partner for this one day. We should have had it in there. We should have allocated some of that to her on her income tax return. But they didn't even do that. It all was over to Mr. Smaldino. And that can be terribly problematic.
We're going to comment in a few minutes about the tax formalities too, because that was all missed. And that's why I say, if Smaldino missed 6 or 8 things, we shouldn't assume that if we get 6 out of 8 things right, that we're going to win. You want to shoot for 8 out of 8 right, because there's always, and Jonathan and Lou, tell me if you disagree, there's always something that's going to be missed. Even a simple transaction like moving LLC interest into a trust, look at all the different pieces that have to be in place. And we haven't even gone through all of them yet. There's a lot of moving parts and a lot of little pieces and a lot of documents for even what's a simple transaction. When you're doing a much more complex note sale with a spillover to a incomplete gift trust or a grad and husband and wife or spouse 1, spouse 2, or each doing transactions like that, you have scores of legal documents that need to be done. I think we need to shoot for 100% so that if we've missed things, the number of things missed is small. And one of the things that I find is when you go through a checklist like I described, and we'll do a webinar on what we do, and we'll show you exactly mechanically how we do it, in case it's helpful to others next year. When you find like the operating agreement that was missing for Mrs. Smaldino's 1 day of ownership, and you clean that up, you're going to be thinking about the transaction. You may find other things. It's really helpful when the dust settles to go back and clean up. Now, let me go through slide 27 quickly, because we've kind of already mentioned it, and Lou said it early on that the court didn't believe it was even a real transaction. They didn't date documents properly. I said a minute ago, if I'm going to clean up a transaction like this in 2022, if this was done in 2021, I would have it signed the date they actually signed it, and I want their signature and then putting the date in, effective the date that it was supposed to be effective. But they didn't do that. Some of the documents in the transaction were dated effective as of the date they wanted it done. They didn't date them the date they signed. You need both. You need both. There's nothing, in my view, wrong with dating something effective in 2021 and showing that you signed it in 2022. It means that's the real time you signed it. You're not playing games. You're not backdating the document. You're saying, we signed this in 2022. We made it effective in 2021. And hey, by the way, the reason we had to do that is because everybody was so overwhelmed we couldn't get it all done in 2021. That's plausible. I think that's defensible. It's honest. What they did in this case, which I think really bothered the court, and let me just talk about it for a second. They dated the documents effective the date they were supposed to be done, but they didn't say the date they were signed. The court believed, and I think this is because there may have been a Wandry valuation mechanism in there, so they needed the value. The appraisals were done 4 months later. So the court believed that these documents that were signed were really signed 4 months later. And in a normal situation, but hear me out, in a normal situation, if they signed them and dated them in August and said effective back in a prior time, maybe it would have been less of an issue. But here's why it was such a critical disaster in the Smaldino case. If they really didn't sign these documents to 4 months after Mrs. Smaldino was supposed to own it, the assets, the LLC interest, were in the trust before she even signed the document saying she owned it. So how could she have any control, exert any ownership over something if when she actually signed the documents, they already were months earlier in a trust? So that was really the death knell to the planning. I think really upset the court. Tom, you want to comment on the lesson, or Lou or Jonathan, on dating? Any of you have any comments on that before we go on?
I think the best, you kind of covered it already here, Marty, but the best practice is to make sure that you're honest, because if you date these documents, even if you're dating it effective previously, if the facts make sense to do so, by putting your date in, you're going into any audit with a different viewpoint than the court has here. The court believes that the taxpayer is playing games. If you have an auditor or a court that looks like that is looking at it with that viewpoint, it's making it much harder for you to make your case. If you go in and you're honest, you say, we missed setting up this operating agreement. We had it effective the day that this happened. We signed it at a later point. You're showing good faith, both for the practitioner and the taxpayer. That lets you negotiate and talk with the IRS from a different viewpoint than if they believe that you're trying to get one up on the government. So it's a small point here, it's a small nuance, but it has a ripple effect throughout the entire planning for the Smaldinos. And you want to have in any planning that you establish for your clients, and this is something to communicate with your clients, you want to be able to have a good faith aspect going in when you're talking with the IRS.
Let me just make a quick comment on slide 30, and then we're going to move on. Even though we've said repeatedly you want to have all your legal documents, all your ducks in a row, the court did note that they're a factor to be considered but not controlling. In other words, doing the legal documents alone may not be sufficient. You absolutely should do them, but go back to Jonathan's comments about economic reality. It's not just the legal documents. Have a distribution, have a vote. 2 comments Jonathan made. Great ways to show reality. So legal documents, I think, are essential, but they don't alone make the case. Partnership reporting. Lou or Jonathan, do you want to comment on what they did in terms of the partnership return? Ignoring it all?
Well, briefly, it didn't show that Mrs. Smaldino had her interest when they did the 1065 for that year, which is not going to support the fact that she was an owner even for a day. So this is an issue, Marty, that we know we have. We have to talk to the accountants. We have to have a team approach, and we have to do post-transaction compliance to make sure that the little items like the 1065 or the 1120, when those tax returns are done, that they're done in compliance with the steps that were taken on the transaction. It wasn't done here.
I'll tell you, by the way, this is not really pertinent to Smaldino, but it's pertinent to a lot of the deals we do. Lots of people use valuation adjustment mechanisms. Wanderies are kind of like tribbles. If you all are Star Trek fans, if you're not, don't tell me. But they're like tribbles, right? We see wandery clauses everywhere. If the accountant doesn't reflect in a statement attached to the K1 that it was, $4 million worth of partnership interest that was estimated for administrative convenience or something to that effect at 32%, we have not been consistent on the income tax returns. And where I think, and forgive my view of this, but I think where one of the problems comes up. So accountants are doing a partnership return on a fixed fee. They're probably getting harassed by the client to keep the fee down, even though their costs are going up. And now we're coming in and saying, listen, you can't just do the K1s for the end of the year. You got to do all these allocations and show K1s for all these different owners during the course of the year. And you better attach these statements for a wandery clause. And the accountant is saying, gee, the client's already beating me up on the fee. How am I going to do any of this? But the reality is we, the attorneys, have to back up the accountants and tell the client, you got to get this done right. And if it's more work, it's more work. But too often the tax reporting is inconsistent. And I believe it was the Wandery case that even pointed out that, and they let the taxpayer win in Wandery, but I think they pointed out that the tax filings were not consistent, not a mistake to make. And ditto on a gift tax return. Jonathan, do you want to comment at all about reporting gifts to spouses and how that relates to Smaldino?
Yeah, I mean, the law was changed a number of years ago, and it happened because of something that I had mentioned to someone on the professional staff of the Congress, that I would often, to get the statute of limitations running, I would often report gifts to the spouse, even though they were qualified automatically for the marital deduction. So he then got the law changed, so you couldn't use that as an excuse by saying you don't have to report any gift you make to your spouse which qualifies for the marital deduction. But it doesn't prohibit you from doing it. It doesn't prohibit you from reporting small gifts. So it's still a good practice. But in those days when this came up, if you filed a gift tax return, the statute of limitation ran on everything, either within 3 years or 6 years. Now, of course, we have a provision which says you don't get the statute of limitations for gift tax purposes to run unless you disclose that exact transaction. And the regulations under 6501 tell you in detail what you have to disclose, and you need to be slavish for that. But the question is, why should I bother to report a gift to my spouse? Well, there are a couple of reasons. Number one, that way you can be sure you're going to get the marital deduction. The IRS can't come in and say, well, actually, it was a terminable interest where you had to deal with your spouse, so it couldn't qualify. In fact, I think the IRS could have argued that Mrs. Smaldino didn't really receive this property. It should have never qualified for the marital deduction. In fact, maybe they could have gone in and gotten it that way, but they chose instead to say that Mr. Smaldino made gift to the spouse. And there's one case where you have to file a gift tax return, and this is critically important. And that's where you make a transfer to a Q-tippable trust. And I say Q-tippable because unless and until you Q-tip that trust on a timely filed gift tax return, Form 709, it will not qualify for the marital deduction. So you put property in a perfectly drafted Q-tippable trust. The spouse is entitled to all of the fiduciary accounting income. Nobody else has an interest during the spouse's lifetime. You say this definitely qualifies for the marital deduction as a good Q-tip described in 2523F. Except in order to get the marital deduction, you must file your gift tax return on a timely basis. For any reason you don't file it on a timely basis, there's no forgiveness, there's no 9100 relief that applies to you. You're simply denied the marital deduction. And as a consequence, you really shot yourself in the foot. And in fact, whenever you're dealing with a client, you need to inform them of that and inform their accountants as well. Because again, if they don't do it, they're going to come back to you and say, hey, you should have told me that in order for this to qualify for the marital election, I had to file a timely gift tax return. You have to do that. So make sure that's on your checklist for all of your clients if you are going to use a Q-tip. Now, the other thing you worry about, and this is a footnote, is when you use a Q-tip, and if you're going to have that Q-tip trust invaded for the benefit of the spouse, like Mr. Smaldino put it into a Q-tip trust rather than directly to his wife, and then you would invade the Q-tip trust and give it to her, there are cases out there which indicate that you're not going to get the marital deduction for that. Or I'm sorry, you're going to trigger section 2519 because, you know, it went to the spouse, but she or he in turn gave it to someone else. You need to be very, very cautious about that. And that's why ordinarily where we have a tax transaction, I use a general power of appointment trust described in section 2523F rather than a Q-tip under E. So keep that in mind that you may want to use a general power of appointment trust to avoid, number one, failing to file the gift tax return on time, and two, worrying about the fact that the IRS may come in and say, well, you've triggered section 2519 because you gave it to the spouse, but the spouse in turn gave it to someone else.
So when I have situations, and we just went through one on a 2020 gift where there was a transfer from one spouse to the other, I tried to get the accountant and the client to disclose it. They didn't want to. The reason I like to disclose it, there's a couple of points just to add, and then we're going to go on. First, I like to tell the whole story in the gift tax return. I find when you're sitting down with an agent and I have an index of exhibits and it's logical and sequential and shows all the documentation, it makes an audit so much easier. How are you going to find the documentation years from now? It's just so much easier to lay it all out, have it there, and I think it shows the credibility of how you're handling the planning to the agent, which makes it easier. Another point, what if you have spouses, and they don't even have to be in a community property state, but what if the property were tainted because they used to live in, say, California or Texas, and it's community property? You have to transmute it. Don't you want to make sure that all that stuff is done right and you lay it out? By laying out the stuff on the gift tax return, you have it all there. It helps you not miss something. So, you know, community property is an issue. You have to deal with all that. So that's why I like to lay it out on the gift tax return and to toll the statute. So the lessons we've already talked about, income and gift tax returns should be all done. So just for a quick recap, at this point, you've seen that there was no economic substance. They didn't do the legal documents. They didn't observe formalities. They had no intent to do it, and they didn't report it right on income or gift tax returns. There was nothing indicating the reality of this transfer other than an assignment. Not enough. The circular nature of the transaction we've talked about, and Lou commented that you know more assets should have been given. Totally agree. You don't want circular transactions. Economic consequences, there should have been, as Jonathan talked about earlier, real distributions, a real vote. There's all sorts of ways to show that this had reality. Substance over form. Jonathan, can you comment on that?
Well, Marty, of course, we've talked about the substance so many times, but you've got to prove that in substance, in this case, that Mrs. Smaldino actually owned the property. The fact that she had known and had apparently agreed with her husband that she would immediately retransfer it to a trust for his children, a trust that he had created, just means that the substance of what they claimed had happened really didn't happen. I mean, think about all the mistakes they made, as Marty said. Number one, you know, they didn't record that she was an owner. Number two, she immediately turned around and gave it, said she felt at least morally bound, if not legally bound. In fact, the question is, what would have happened if she said, well, to her husband, guess what? I'm going to keep these assets. You know, he would have gone in and said, no, you had agreed, and so on and so forth. They didn't have it on any of the income tax returns. He didn't even report it on his gift tax return. It just could not have been worse from a substance point of view, I think.
It was pretty bad, folks. Now, Tom, do you want to explain the marital deduction argument, or would you like me to do that?
I can do it quickly here. So
Yeah,
in the
quick is
case,
good.
Mr. Smaldino made the argument that the marital deduction should supersede the substance over form argument. He was saying that because of the fact that he made a gift that applied to the marital deduction, that in and of itself proved that Mrs. Smaldino owned this, and then she made the gift to the trust. The court rejected that argument, saying that no, that's not what you look at here. Substance over form will still apply, even if you're trying to argue a marital deduction. And the fact is, the way that you structured this transaction, she never really owned this interest. It was really you making the gift.
So, Lou, you think we should cross that off the list for all the slats we've all been doing if we have an issue?
No comment.
Not worth arguing that one?
No, we'll come back to what I think Mr. Smaldino was thinking when he did the transaction, but we'll wait until the wrap up on that.
Folks, it's obvious to everyone on the call, so we don't need to belabor it. But, you know, related party transactions receive a higher degree of scrutiny. We all know that. So, you know, we often see that, you know, if we had a real business corporate transaction where unrelated party is selling something to another unrelated party, you know, they can agree to anything they want. They can skip a step or two if they're all comfortable with it. But you can't do that in estate planning. You really got to be compulsively detailed and sequential. And that's why we like to create a checklist for transactions so that if there's a step or document missing, we can try to hopefully identify it. Holding period, we've talked about that. Corroborate ownership in the donee, we've talked about that. Correcting prior transactions, we've talked about that. Lou or Jonathan, do you want to comment at all further about going back to correct prior transactions and making sure everything is all the I's are dotted and the T's crossed?
Well, I think we've hit that one pretty hard. And Marty, you made a point earlier I want to corroborate, which is in any transaction that we do perfectly, there's going to be one or two items that actually are not done perfectly. And so I know we all take a deep breath when we finish projects because sometimes our clients make it very hard for us to get to the finish line. And we put it in a pile and we say, we'll look at it later. And 2 years later, that pile is still there. I think that I think this case is a lesson again for us to do post-transaction cleanup for all planning that we do, not just the Smaldino kind of planning, but all planning. So, and again, we hit that hard, Marty.
Yeah, and I think again, and I know I've said it, but I'm going to repeat it because 2020 and 2021 are just crazy years. And you know, I don't think it's getting any easier or less crazy as we get towards the holidays and the end of the year. It's going to remain pretty nuts for all of us. We all have to circle back and tell clients, unlike all prior years, anything we did in 2020 and 2021, you got to give us a call. We got to have a meeting. We got to review it all. And the right way to do it, I think, is to put together a checklist for each transaction, circulate that to the advisory team. The insurance consultant should get it because if there was insurance transferred to the slats or other irrevocable trusts, and we had lots of that in both years and still have it going on, you want to make sure the insurance agent is clear on the plan and addressed all the changes of ownership and beneficiaries. You want to make sure the wealth advisors involved, right? We've seen situations where wealth advisors were kept out of the loop and had the wrong account names, wrong account numbers. I mean, you know, you got to get them involved. We've talked about the critical role of the accountants. It's really imperative that we put together some kind of summary and get every advisor from every angle to look at all this. And the issue with clients, they're not going to want to deal with it. They're certainly not going to want to pay for it, but it's the only way to make sure that we've cleaned it up. Jonathan, do you want to make any conclusion comments?
Well, Marty, what you just said is true. I often use revocable trust or did use revocable trust in my practice. And I tell the client to really get mileage out of this, you've got to transfer ownership of the assets to that trust. And the client would almost always say, don't worry about it. I'll take care of that, or my secretary will take care of it. And I would check back 6 months or a year later and nothing had been done. So I began to put in my engagement letter the fact that, you know, they were responsible for this, and if it didn't happen, they were going to bear the brunt of it. They just didn't want to pay for it. And even though I tell them at the beginning, you're not going to do it, I know you're not going to do it, they didn't do it. And, you know, we had some bad situations, but at least I was covered because I had told them repeatedly that they had to do it, and they did. And that's the same thing kind of here. You know, why wasn't Mr. Smaldino filing a gift tax return for the gift to his spouse? Why didn't the corporate documents or the LLC documents get changed to show she had been a member for a day? I mean, all of that, it has to be done. And again, if it blows up, you've got to remember that being the attorney, they're going to try to come back and blame you for it.
I would almost modify what Jonathan said by saying, of course they're going to come back and blame you. It's almost guaranteed, like the sun rises in the morning. They're going to blame the attorney, even if somebody else was responsible. That's why we like to do the checklist of the transaction. So we've kind of put the client and everyone else on notice what they need to do. And Tom, can you just real quick, what do we put in all our representation or retainer agreements about the essential need for an annual meeting?
We put in multiple documents to our clients that it is absolutely essential that you review your transactions, depending upon their complexity, pretty much every single year. We say in our representation agreement, in our risk factors, in any letter that we send to our clients, either closing a file or sending them documents to sign, these plans are not done the second that you sign them. You have to follow up on every single aspect. And things change throughout the years. So when you look at it that way, you have to have an annual review. And I believe it was Jonathan that mentioned earlier that the client only really gets the lesser of substance or form. So when your plan is put under a microscope by the IRS, by the courts, they're only as strong as the weakest links that you have. So by going back every single year, or at a minimum, the year after a transaction is set up, and then every couple of years after that, you are looking at the links that are established in this transaction and also how they change over time, because it may be that a T that wasn't crossed isn't really noticed until a year or two later, or something economically changed that causes you to look at the transaction in a different light. Maybe a case comes out that has some concern about the transaction, so you want to take a look at it and see if you could take some corrective actions. By having these annual review meetings, you're really telling the client, this is a living, breathing transaction. This isn't a one and done situation. Estate planning simply does not work that way.
Anybody else have any final comments before we close?
I'm going to add one. I imagine, Marty, this case being Mr. Smaldino saying to his attorney, me, you, Jonathan, Tom, yeah, I really don't want my second or third spouse to have control of these assets, and us saying, well, you know, she has to have them for a period of time. Well, how long? Well, you know, I don't know, a month. No, I can't. 10 days? No. 5 days? No. Well, what are you comfortable with? Well, maybe if she transfers them the day she gets them. You know, and that's just not going to work. It's not going to work with any client. And I think it's incumbent on us at that point to go, no, we can't do that transaction, period.
Are you suggesting firing a bad client?
Depends what day it is. What are we, Tuesday? Yes.
Let me make one final. Jonathan, did you have any comments? Because I have one final point.
No, go ahead, Marty.
So what I want to get all of you is really excited to hear the webinar Jonathan and I will do next year on the Welling case. So let me give you a point. What I think is important to do, and it's something I'm saying to all of you because I want to think about making sure I do it. When I'm finished with the planning now, and I get the client back in 2022, hopefully, to review and update and address all the things we've talked about in this hour, more than an hour, almost hour and a half, I want to make sure that I've closed the engagement on the 2021 planning. They sign a new engagement letter representation agreement, retainer agreement in 2022, and we open a new file, because that then closes the representation for 2021's planning. So it starts to toll the statute of limitations. And now we're opening a new matter and you want that language in your communications to the client, because that will be protective to you as practitioners. And that's something to think about. And we're going to talk about that in the context of our review of a Welling case in a webinar we do next year. So I want to thank Jonathan Blottmacher, Lou Harrison, and Tom Tietz. I hope this was informative. I thought the Smaldino case, well, you could have just, bad facts, really informative and great reminder. You probably knew everything we talked about, but it's a great reminder of all the things we have to do right, and there's a lot of them. So I wish you all good luck for the rest of 2021, and hopefully we will not be spending New Year's Eve doing documents like we did in 2012, but I fear that's coming. So good luck, everybody, and be safe. We should end with that quote from Hill Street Blues, right? You know, be safe, it's dangerous out there. Take care, everybody.
Bye, Marty.